Hello students, and welcome to the video on property, plant and equipment. Our quote of inspiration for this week is by George Bernard Shaw, and he said, "Life is not about finding yourself, it's about creating yourself." So that's just a reminder that you can achieve whatever you want in the world. Our study outcomes per study guide is to apply the acquisition, revaluation, depreciation, impairment, disposal and disclosure of PPE to calculate the cost price of an asset and to present the note property, plant and equipment. So as an introduction, property, plant and equipment is a term that refers to fixed assets that are kept by the entity, and these fixed assets enable the entity to carry on its trade in the day-to-day operations. And according to IAS 16, PPE may include the following: buildings, machinery, land, equipment, plants, aircraft, vehicles and furniture and fittings. The value of PPE is very, very important because disclosing an accurate value for PPE is of great concern, because overstated or understated assets can influence decisions taken by those who have interest in the company, either direct or indirect. The valuation method for PPE must be included in the accounting policy of the company. I am sure you are familiar with accounting policies. And the valuation of PPE is influenced by the PPE model that is applied. And we have two PPE models. We have a cost model and a revaluation model. So what I've done is I've created now two videos. So video 1, which is this video, will be all about the cost model, which is slide 7 to 29. And then the revaluation model will be on the second video, which you must also watch. And that will be slide 70 to slide 56. So be sure to check out both of those videos that I have created for you, and this video will then continue to talk about the cost model. So the cost model and its applications. So the cost model is the model that you've always applied, and the cost model says that we can never ever revaluate assets and we cannot have a revaluation surplus. So for the cost model, there's a little mind map that I have drawn up for you, and it says that the calculation of the cost price of the asset must be done here. You need to be able to write off depreciation, straight line, reducing balance and the production unit method, which are the three methods we will use in this study unit, and then also write off impairment losses by determining the recoverable amount. So the write-off of impairment losses will now be a new concept to students, which we will also do. So first and foremost is you need to know how to calculate the cost price of an asset. And this is very important that you study these slides because it's very theoretical. You need to know, they will give you, in a question, they will give you a list of costs that had been incurred, and you need to know which of these costs must be included in the cost price of the asset. And if you don't know, then all your subsequent calculations will be wrong. So it's very important for you to study this. The first thing that is included in the cost price of the asset is the initial acquisition cost. So that is the purchase price of the asset. Then also costs to prepare the site. For example, when an asset like a building is being constructed, that the cost to prepare the site is included. Then also any delivery costs and fuel costs, import duties, handling costs, installation and assembly, and then also your labor costs of construction. So again, if we have a building that should be constructed, the labor cost is included. The registration costs that are incurred in order to bring the asset into use, any legal costs to prepare purchase documents and agreements, and also the cost of testing. So the cost of testing is sometimes a strange one. It's, for example, when we have a machine and the machine is now used to produce items of inventory, and now we are testing the machine to see if it works. So we may produce, let's say, 10 or 20 items to see if it's working. So that cost to test may also be capitalized to your cost price. But if you are able to sell these samples, so these items that you have now created due to testing, if you are able to sell them, then the selling price or the proceeds from those from the sale must be deducted from the cost of testing. Then there are also certain costs that may not be included in the cost price. So costs that are excluded is any admin cost. That's like phone billing, bookkeeping, emailing, whatever costs incurred there. Then also advertisement and promotional costs. We may not capitalize those. Staff training costs. So if you have new technology, new equipment, and you need to train your staff on how it should be used, then those training costs may not be capitalized. Also initial operating losses. If you have an initial operating loss, for example, a machine, and it's operating at a loss, that loss may not be capitalized to the cost price. And then also subsequent costs may not be capitalized to the cost price, and subsequent costs may be reallocation costs. So if you are moving this asset to a new site, or repairs and maintenance, and then also valuation costs. All the costs listed on this slide must be expensed. Then write-off of depreciation. I know that students are already familiar with this concept, but I just want to make sure that you understand the differences between the depreciation methods. So I have an example here. It says a machine is purchased for 100,000 Rand on 1 January 2016. Determine the carry value of the machine for the financial year ending 28 February 2017. And there they provide you with the depreciation method. They say the asset is depreciated on a straight line basis over 5 years with a residual value of 10,000, and the asset is depreciated on the reducing balance method at 20% per annum with a residual value of 10,000 Rand. So here I will do the calculation for the solution for number A. We will say the cost is 100,000. Then I need to write off depreciation. So I will say 100,000 less my residual value divided by 5 times 2 over 12. Because we are calculating depreciation on 28 February 2016, and this asset was obtained in January. So it's January, February. That gives us 3,000 Rand and a carry value of 97,000. Then depreciation for the next period will then be the 100,000 less the 10,000 residual divided by 5 years times 1 year, which gives us 18,000 and a final carry value of 79,000. The solution for B will look a little bit different because now we are using the reducing balance method, and the reducing balance method says that we need to write off depreciation on the carry value of the asset. So we'll again start by saying the cost is 100,000, so the depreciation will be 100,000 less the residual times 20% times 2 months. That gives us 3,000 Rand and a carry value of 97,000. For the next year, we will take the carry value of 97,000 less the 10,000. So can you see we now take the carry value less the residual value times 20% times 1 year, which gives us 17,400, and that leaves us with a carry value of 97,600. The other method that is used is the production unit method, and the production unit method works in terms of units like kilometers, production hours, etc. So here's an example, and it says a vehicle is purchased for 150,000 Rand on 1 January 2014. It is depreciated over a total of 1.5 million kilometers, and the following kilometers are traveled. In 2014, 200,000. In 2015, 180. Then you need to indicate the journal entry for depreciation at the end of 2015. Then you will say depreciation is 150,000 divided by 1.5 million kilometers. So that there we have used the kilometers, we've divided by the kilometers, times 180,000 kilometers that were traveled. That gives us 18,000 Rand depreciation, and our double entry is debit depreciation, credit accumulated depreciation, vehicles. The next topic is impairment losses, and impairment losses will now be new to the students. All right, so what is an impairment loss? An impairment loss is an additional amount that's written off above and beyond depreciation, and impairment losses are normally written off because the assets have been damaged or the value deteriorated significantly. So impairment losses can be when the asset was in a hailstorm or in some kind of accident, and also the value can deteriorate because of technology. So if we have equipment and there's better equipment on the market in the new year, then the equipment we have will be worth less. So we need to write off an impairment. So an impairment loss is an expense, and the double entry is we credit impairment losses, or we debit, I beg your pardon, impairment losses, and we credit accumulated depreciation. Impairment losses require the carry value of an asset to be written down to an amount that is equal to the recoverable amount. So what is a recoverable amount? It's the highest of the value in use, or the fair value less cost to sell. So I think impairment losses are a little bit difficult, so we will do an example on these slides. The next question is, when do we measure impairment losses? So impairment losses can be measured during the financial year or at the end of the financial year. So I've set out certain steps for you that you need to perform when you are measuring your impairments. So you need to first determine, is this an impairment during the financial year or at the end of the financial year? If it is during the financial year, you have 3 steps that you need to follow. Step number 1 is you need to measure your depreciation. Step 2 is you need to measure your impairment. And the formula for impairment is your cost price less accumulated depreciation less recoverable amount. And then step 3 is to measure further depreciation by taking the recoverable amount less the residual value divided by the remaining useful life times the months until year end. So this sounds a little bit difficult, but we are going to do a practical example. Then if your impairment is taking place at the end of the financial year, step 1 is still to measure depreciation, step 2 is still to measure your impairment, but step 3 will be ignored. So if it's at the end of the year, there will be no step 3. So I've created an example here for you, impairment losses measured during the year, just to see, or just to teach you how you should approach questions like this. So Bella Limited owns machinery, and the machinery has a cost of 120,000. Depreciation is written off on the straight line method over 5 years with a residual value of 20,000 Rand. Then Bella Limited has a financial year end of 31st December. On 1 January 2014, machinery was correctly disclosed as follows. Cost was 120,000 and accumulated depreciation was 30,000. On 30 April, so this is now in the middle of the year, they say machinery was severely damaged, and on this date the fair value of machinery was 70,000 while the cost to sell was 5,600 Rand. The value in use on 30 April 2014 was 65,000. On 30 April, the remaining useful life of the asset was 38 months, and you need to indicate the journal entries that should be processed. So now you need to apply your 3 steps, because we know it is an impairment loss during the year. So the first step is to determine the depreciation on 30 April. So there we will say it's the cost less the residual value of 20,000 divided by 5 years times 4 months. Why 4 months? Because it was January, February, March and April. That gives you depreciation rounded to the nearest 1 Rand of 6,667. Step 2 is to determine the impairment loss. So there's a formula for impairment loss. It says it's the cost less the accumulated depreciation less the recoverable amount. So now I need to determine my recoverable amount. What is my recoverable amount? It is the higher of the fair value less cost to sell, or the value in use. And this is how you know you should do an impairment. You see fair value less cost to sell and you see a value in use. When you see that, you know you need to measure an impairment loss in a question. So our fair value less cost to sell will be 70,000 less 5,600, which is 64,400, and our value in use is 65,000. Then our recoverable amount should be the higher one of those two, the higher of 64,400 and 65,000, which is 65,000. So then our calculation for impairment will be 120 cost less my accumulated depreciation at the beginning of the year, less the further accumulated depreciation that I've written off, less my recoverable amount, which is 18,333. Then step 3 is to determine the depreciation until year end. So here's also a formula that you need to apply. You need to take the recoverable amount less the residual value divided by the remaining useful life times the months till year end. So the recoverable amount was the higher one, which was 65,000. you need to deduct the 20,000, which is your residual value. You need to divide by 38 months. The 38 months was given to you in the question. If we could just go back, they say on 30 April, the remaining useful life of the asset was 38 months. So there it was given to you. Should be applied there. And then times 8 months. So can you see we just put times by 8, not 8 over 12, because the 38 is already in terms of months. So we times by 8 because that's the months until December. That gives us depreciation of 9473.68 or rounded 9474. Then our impairment loss, our journals for impairment losses measured during the year. So there we will say our journal is then debit depreciation, credit accumulated depreciation, and that's our step 1. Then step 2 is to recognize our impairment loss. So we'll debit impairment loss, credit accumulated depreciation and impairment losses. If you just write accumulated depreciation, you will still be awarded the mark. That is the 18333 in step 2. And then step 3 is the further depreciation that we've measured. It's debit depreciation, credit accumulated depreciation 9474. If we need to do our property, plant and equipment note, we will then say at the beginning of the year we had a cost of 120 and accumulated depreciation of 30,000 rand. That left us with a carry value of 90,000. This information was given. Then we need to show our depreciation. So depreciation is the sum of the 6667, which is step 1, and the 9474, which is step 3. Our impairment loss is showed separately. It's deducted, as you can see, 18333. So our cost will still be 120,000, but our accumulated depreciation and impairment losses will now be our 30,000 plus our 16141 plus our 18333, and that gives us a carry value of 55526. Not too difficult. Then impairment losses measured at the end of the year. So here I will again use the same example, but now the impairment is written off at the end of the year. So I'll say again, Bella Limited has machinery, and again it's 120,000 rand written off straight line over 5 years. Again a residual of 20. Again a cost of 120. Accumulated depreciation of 30,000. But now it's written off on 31 December because it's severely damaged on the last day of the financial year. Then again the same fair value, the same cost to sell, the same value in use, and again we need to do the journal entries. So here step 1 is again to determine depreciation, but now we need to determine depreciation for the entire year because it's at year end. So we'll say it's 120,000 rand cost less the residual divided by 5 years times 1 year gives us 20,000 rand depreciation. Step 2 is to determine my impairment loss. There's a formula for impairment loss. It's my cost less my accumulated depreciation less my recoverable amount. So my recoverable amount will again be the higher of fair value less cost to sell or value in use. My fair value was 70,000, my cost to sell was 5,600. That gives me 6,400. The value in use is 6,500. I need to choose the higher one, which is the 6,500. Then I can determine my impairment loss by saying it's 120 less 30,000, which is my accumulated depreciation at the beginning of the year, less the 20,000, which is the accumulated depreciation that I would have written off there, and then less my recoverable amount, which gives me 5,000 rand impairment loss. Very important, we don't need to do step number 3. Then step 1 is to recognize my depreciation. So I'll debit depreciation, credit accumulated depreciation with 20,000 rand. Step 2 is my impairment loss. I debit impairment loss, credit accumulated depreciation and impairment loss with my 5,000 rand, which is step 2. There will be no step 3. Then I need to do my note. Again, the same at the beginning of the year, 120 less 30 gives us 90. My depreciation was 20,000. My impairment was 5,000. My cost at year end is still 120. My accumulated depreciation and impairment losses is 30,000 plus 20,000 plus 5,000, which is 30 plus 20 plus 5, and that gives me a carry value of 6,500. Alright, the revaluation model I will be doing in video number 2, so be sure to also watch video number 2. Thank you very much for watching this first part, and then I will see you in the second video.